Welcome back to Higher Exchanges. I'm your host, Jesse Redmond, Head of Investor Relations and Business Development at Leaf Brands. I'm joined this week and every week by Morgan Paxia. He's the co-founder of Poseidon. Morgan, what's going on, man?
Happy Friday.
Happy Friday to you. You're looking tanned and well-rested. You've been in San Diego or on the road?
I was on the road this week. I was actually in Scottsdale, Arizona. It was pretty cool being with one of our portfolio companies, Flow Hub. They were doing an all hands and didn't stop us from jumping in the car and going and checking out stores. And we also met with some of the Arizona operators and one of our portfolio companies. So it was a good trip, and it was a surprisingly nice, easy drive from San Diego. So I just got in the car and went.
I'd imagine it was not nice and cool in Scottsdale in August.
No, yeah, I think it was like 110 there, and it was like 113 driving through the desert on the way back. So yeah, AC was cranking.
Nice. Well, we have an awesome first-time guest joining us today. You may know him from his recent roles at Ayr, and he just launched a new venture called Pacific Grove Advisors. Jamie Mendola, welcome to the show.
Thanks for having me.
Yeah, we're excited to talk to you, Jamie. Certainly followed your career and your work for a long time. Maybe let's start things out by rewinding. You're one of those smart guys. I think you went to Stanford, if I recall correctly, and you did some really cool stuff out of school. Not too different from me. You started on the finance side, got into the hedge fund industry. So maybe you can kind of frame things early in your career and tell us how you got started in finance.
Sure. So I started my career in investment banking and private equity in New York. You're right. I did go out to Stanford for business school. Similar to Morgan, I grew up in Buffalo, New York. So I thought I'd have a 2-year adventure out in California. And I think when I came out in January and saw palm trees and played a round of golf, I think that had me hooked. And I have not left the Bay Area pretty much since. So it's been in San Francisco for about 20 years now. After business school, spent some time at a couple large hedge funds, then started my own fund in 2014, where we were a big investor in a lot of small to mid cap consumer e-commerce and technology and software companies. And then I was one of the earlier investors in cannabis, primarily on the private side through some of the MSO private rounds, as well as some of the smaller California operators. If anyone remembers, John Sandelman launched a SPAC back in 2017. I invested in that SPAC through the fund. We got to know each other pretty well, and I ended up joining his family office, to work on both Ayr as well as set up a separate SPAC, which ultimately culminated in the business combination with GLASF. And then a couple years into Ayr's evolution, after doing a lot of the M&A and some of the business development and capital markets work, I jumped in to the operations side, where I had elevated levels of responsibility, culminating as co-chief revenue officer. So got my hands dirty, on the operations side, not just someone sitting at the top looking at things from a strategy and capital perspective.
So I think, Jamie, when I graduated college, I didn't go to grad school. I went to UCSB and studied economics there, and I graduated in 97. And if I asked a young Jesse back then what he would be doing at the ripe old age of 50 today, cannabis wasn't even something I would have thought about. I was a cannabis consumer, never sold weed, never grown weed, never been involved in the industry. And obviously back then in the late 90s, early 2000s, the idea of it being a legal business where we could all, sit here doing things like we are today, wasn't really conceivable. So when you were a 23, 24, 25-year-old Jamie Mendola, what did you think you'd be up to today? Like, what were you planning for in your career?
Yeah, it's hard to even remember thinking that far, back, because I think at that point I was just putting one foot in front of my other and taking advantage of some of those opportunities and working with, really smart people and getting some great mentorship. Quite frankly, I was taking a lot of sports classes, and I actually wanted to be a general manager. And so I had some interest in moving down that path in my career. I was a baseball player, played a lot of sports growing up, and that was always something I was pretty passionate about. But as I got into the investing game, and particularly some of the training I received, where we're looking for really industry style transformations as well as company transformations, cannabis had a lot of those same, parallels to what I saw earlier in my career with things like organic foods, right? With Whole Foods thinking that was a super niche-y thing, not something that would go mainstream, or Lululemon and athleisure. There's a lot of similar parallels where you look at consumer adoption and penetration and what that, total addressable market might be. And cannabis fit a lot of those things that I had seen. And I think I was at the stage in my career where, as much as I love investing, I was getting a little bit burned out by the day-to-day grind. And I wanted to jump into something where I could help create and shape an industry as opposed to just be a passive investor. I also had a personal story. My mom had MS and my dad had cancer. And so that was really a personal catalyst, for me to go down the education, process of the wellness and medical side of this industry, which I was not that familiar with back in 2010, 12, 14. So I went through the same journey that a lot of folks in this industry have gone through, where it's a personal passion as well as a professional passion. And we've clearly seen the consumer adoption, move up to the right. That part's worked every bit as well as we all expected. I think it's how much of that growth has come into the regulated channel versus, hemp or the illicit market. And then obviously there's been massive price compression across many of the markets that's sort of taken away from some of that volume and consumption growth as alcohol has gone down. Obviously there's a lot of great stories about veterans using cannabis, people replacing opioids. So there's so much good that's happened, and a lot of the high level things have worked out. And it's just unfortunate that not all of that value has accreted economically to the operators, or certainly it's been more challenging than many folks expected.
Yeah, present company included from the personal side, Jamie, as you know, and it's amazing how many people that have come to this industry. It's because of personal initially, right? And then they start looking at it from the investment side of things or the operating opportunity side of things, and the ability to align, something that's either could have been beneficial or was beneficial for them and their families, and aligning that with what they want to see is, to your point, is be a part of the change. But I was just curious, thinking about how you got in, to your point, was looking at, it was a SPAC originally, to your point. Was the structure of a SPAC, was that appealing, or is it more the idea of getting access to one of these operating businesses and that was attractive? And just kind of curious, if you can remember back to when you were doing that underwriting, what you thought could potentially happen. And obviously we know, how things have played out over the years, but just kind of curious if you've gone back and looked at that again.
Yeah, so look, back in 2017, SPACs were relatively rare. It was a pretty niche, business. I think at the time there couldn't have been more than about $3 or $4 billion of SPAC issuance per year. So that was pretty small. It obviously then ballooned up in the subsequent years, and things got a little sloppy across many industries with the SPAC issuance and raises. But I think what was interesting is not so dissimilar to what this industry struggled with for the last several years, which is access to capital. And, I was fully in the belief that if you either backed, one of the larger operators or put together a portfolio of high quality businesses that generated, cash flow and had good margins, 17, there weren't that many businesses of scale, right? That was when a lot of the MSOs were starting to come together and put their footprints together. So while we looked at some of the now known as top MSOs, there was an opportunity to go find strong cash flow producing businesses that had scale and had operational, talent, and put them together into a portfolio. And like many things, there tends to be a bit of an arbitrage opportunity where when you're buying a single state operator, you can buy them at a multiple of, EBITDA or cash flow that is a lot lower than if you're paying for the platform value of what was then Cresco or Curaleaf or GTI, where you would have had to pay for multiple years into the future. So that part of the Ayr journey, I think, was quite attractive. Those businesses were bought at a very attractive multiple with very strong operations in Nevada and Massachusetts. And I think we did actually a pretty good job of identifying the good markets that we wanted to go into where we could build, scale and where the fundamentals were, reasonably attractive. I think most people that looked at Ayr, and obviously there's been some challenges, so I'm not going to say we didn't, we did everything right, but the markets that we chose and where we built out were probably as good as, any operator out there. And so we avoided the fallacy of chasing footprint and trying to be in as many states as possible, and tried to pick the 7 or 8 states that we thought would have scale, reasonable profit margins, and where we have the ability to compete. And I think post the SPAC over the first 2 or 3 years, I think we probably did about 10 M&A deals to build out that footprint that I think is right up there with the top operators in the industry.
Yeah, really amazing to think back to the day when M&A was a regular headline in our space, where things were moving and getting done. And I look forward to that day when there's a lot less friction and things are starting to get done on a more timely basis. We were all chatting before we got on here just about how it's this part of the cycle is just really hard to get things moving. It's just, people are grinding like crazy, but, to actually affect transactions and things like that, it's really tough.
Yeah.
And on that note, just to pause there, Morgan, like I've felt a distinct change in the type of conversations I've been having over the last month or so. Maybe not just limiting this to M&A, but it just feels like I've had outreach from a couple of people at large organizations hadn't talked to in a while on the operator side. Same thing, some conversations getting rekindled on the investor side. So I don't want to claim we're at the precipice of that M&A stuff picking up quite a bit, but I don't know if you feel it on either of your sides. But I was thinking about that last night, that it does feel like over the last month or so, the quality of the conversations that I've had has increased.
Well, I'll jump in first, and I'm curious to hear Jamie's thoughts. But I don't think you can discount the fact that MSOS has had over 100 million of inflows this summer. So naturally, I think it does start with public companies, and I haven't seen a lot of movement yet private side. I think it's still pretty largely contained to liquidity. I think people are just maybe it just takes time, right? And so we need to see. I think a lot of people are just asking, is this durable, or is this just another moment like we've seen many times over the years? And so if there's some durability, then you'd expect it to slowly proliferate down into under the private side, which would be fantastic and welcome. But yeah, I think it's really a test around that durability aspect. But I can tell you, over even the last several weeks, I mean, people have been pinging me like crazy, mostly just wanting stock tips.
Right.
So not really my forte to do that, but because I'm not in this for the trade. And I think there's a lot of money that is playing the trade, this idea. So again, that's why I'm just wondering as well, is there durability, or is this just a trade for a lot of people? So it would be welcome if there's more permanence to it so that the system starts functioning better. But I think it just remains to be seen. Jamie, what do you think?
Look, I think you're right. Obviously, the MSOS has doubled here in the last 90, 120 days. So not surprisingly, I'm sure you have some folks getting prepared more so than in the hunker down mode that virtually every operator's been in for the past 2 years or so. That being said, I think you're right. We need to see if this is durable or not, because at the end of the day, most of even the large operators outside of perhaps the top couple have had some level of balance sheet stress. And while they're not distressed, people have been very protective on shoring up their balance sheet, extending debt maturities, and making sure that they're not getting in over their skis, so that if the capital markets don't thaw, they're in a tough situation. Equity multiples, by and large, are still pretty low, even with the big moves. Again, with the exception of maybe Curaleaf and TerraSend and a couple others that have a decent multiple. Most of the other good operators are trading at 4 or 5 times EBITDA. And so that's still probably not a big enough multiple arbitrage relative to private company expectations, where you're going to see a lot of deals get done for equity, because good operators aren't going to want to sell at 3 times. and there needs to be a couple turns of multiple arbitrage there. And I don't think there's enough confidence that there's access to the equity capital markets where you can go raise cash, and people are going to be very careful about the cash that they're deploying. So I think you could see a couple small, single, dispensary deals. You're seeing a lot of the MSOs try to bolster up their scale in Illinois and New Jersey and Ohio, some of which, may be done through, partners or structured deals and things of that nature. So I think there's ways to play offense without going all in. And I think you'll see that start happening first. And then the larger stuff may happen if you get Schedule 3 or descheduling and the equities start moving, and maybe people can tap into the capital markets. But I would probably be a little more conservative on expectations of big M&A until you have a lot more visibility on those pieces.
Yeah, I know we're totally off script at the moment, but I just, as a follow-up, what do you think is like a priority for these large companies? Would it be first to, if they can tap equity, or do you think maybe some strategic transaction with a stapled financing, to try to do a 2-for-1 on doing some equity? Like, how do you think they're considering this environment? I totally agree about your point. Like, the challenge is there's not enough arbitrage of the public to the private, so they do need another turn. But when maybe they do get another turn or two, but are they first going to think about, let's take this opportunity, the window's finally open, let's just do equity while we're in this moment? Or do you think, they're going to look at some opportunities that can add in growth and shore up their balance sheet?
Yeah, look, I think at some point growth is going to start becoming more important. I'm sure we'll talk about this, in more detail. But as everyone's gone into defense mode, quite frankly, I think most of the operators that have done a decent job of protecting margins and getting more efficient as they've taken the foot off the pedal on growth in general. But that being said, it's also being reflected in the top line of this industry, right? Even the best operators are seeing, sequential revenue declines, year-over-year revenue declines. So as much as we're all excited about the prospects for some of the federal reform, if you put your pure investor hat on and take yourself away from cannabis and say, what if this was a consumer or retail industry? Outside of the fact that the multiples are probably too cheap and there needs to be a lift in valuations, quite frankly, there's almost not enough that's attractive. If you were looking at a quick service restaurant company that had negative 7% comps, how excited are you? Like, even if there's all the investors in the world that can invest, that's not good enough, right? So I do think that you need to drive scale, efficiency, and some M&A. Obviously, people want to see improvements in organic, performance. But I think there's going to be a little more pressure, as things open up to drive, growth without putting the balance sheet at risk. Because quite frankly, if you do that, growth doesn't, matter. But I do think that's going to start to get in the calculus of the boards and the senior executive teams on where we need to go from here to the next 2 or 3 years, because status quo probably just isn't good enough.
Yeah, I agree with that. Absolutely. And it's, yeah. So maybe we'll get back on the agenda a little bit. So going back, rewinding a little bit to the, when the SPAC happened. So you invested in the SPAC and initially went into Ayr. How did the transition happen from being in the investor seat to being in the operator seat? Was that a push or a pull, or how did that all happen?
It was just a bunch of conversations over a 3 to 6 month period with a few of the other kind of founder and principals. And I think we saw, had some alignment on the strategy. And I thought, my skill set and my connections, in the industry would make me a key part of helping, build that business. And the reality is, when I first moved over, given that 80% of my time was really on M&A, the skill set and what I was doing day to day, outside of the fact that it was a little more private equity versus public equity, wasn't really that different, right? You're looking at market structure, diligence, financial models, et cetera. So that part felt more comfortable, to me relative to my, history and skill set. It was really when it was like, hey, we've had a bunch of turnover on the operations side. Some of the people in the operations weren't, working as well as they should have. we need you to, jump in and really start helping to run the business. That was my biggest adjustment, period relative to my personal experience. And that was really, it was a fun opportunity, for me, but that was much more different than the first couple of years of doing the deals.
Yeah. And when you were first starting to do some of these transactions, I mean, even in that time, it was still pretty early. So how were you trying to assess valuation for these transactions?
Yeah, so I definitely had an interest in the later stage medical markets that had, reasonable chance of moving to adult use, within the next 1 to 4 years, where, hopefully you're paying a somewhat reasonable multiple on the medical business with a lot of upside ahead. So that would be, Florida, Ohio, Pennsylvania, Arizona. I guess those were sort of the, big ones. We were trying to piece together a bigger operation in Illinois and sort of got caught, in the middle when the capital markets started falling apart. But most of the M&A was in medical markets. And, some of those markets have moved to adult use. Some of them have moved a little slower than we expected, and I think are still going to happen. It's just a matter of time. But I think that tends to be where the value is either early stage AU, where you're not paying the fully ramped up market, or something that still has the opportunity to get that torque and that juice. Because unfortunately in this industry, if you pay a full multiple, once the markets have already moved to adult use, I haven't seen enough markets that have sustained organic growth that if you pay 5, 6, 7 times EBITDA or whatever multiple you can get things done at, that there's enough, room, to run enough value creation, unless there's just a ton of synergies or it's a business that was run, very sub-optimized.
Right. So one more for me, and I'll pass it back to Jesse. So with that, because I totally understand, like, especially at that time, we were in growth mode as an industry. Like, it was very healthy, and your idea, the arbitrage of that flip was meaningful for growth. But here we are today, many years later, we still have more states to make that turn, but they've also lasted a lot longer in medical. So, how much more will there be that inflection, that stair step? So if you were to think about M&A today, how would you approach it differently than how you were thinking about it back then?
Look, I think for everyone, it's probably placing less of a premium on the future, right? And, more focus on current cash flow, metrics as it sits today, where all the, value instead of only a portion of the value probably accretes to you. I think too, the way that we capitalized, the business, and there were, folks with different, opinions, of course, like there always are. But I think we debt funded probably more of the growth than we should have relative to the visibility on performance. And that wasn't just really M&A. A lot of it was post M&A going to build out, larger scale cultivation facilities through either CapEx dollars or sale leasebacks. In markets like Massachusetts, where we had a great operation, a great facility, a great director of operations that was probably one of the best in our entire organization, but the market just fell apart. And, there's a lot of discussion around costs, and I'm sure we'll get into that. But when bulk costs or bulk pricing gets to $700-800 in a market, there are very few people making money. And, maybe there's some smaller operators that have a special skill set and are super efficient. But I think it's very challenging for the MSOs to make returns there and to get a return on capital on, $20 to $50 million investment in those markets. I think the expectation was when you deploy that capital, you're going to get the corresponding cash flow. And I think, not just for us, but you look at others that were in Michigan or Massachusetts or other these markets that are in free fall, people deployed capital and they maybe were break even or even losing money. And so that was as big of a challenge as any, because that's what really ballooned some of the balance sheets, is the expectation that you're in investment mode, you get a return, you make the investment, and then you got nothing. And that was not the expectation for a lot of folks on the investment and the operator side, but that price compression happened so quickly. And I think, those were not the expectations. We all knew $3,000, pounds weren't going to exist forever, and maybe not even 2,000. But I think people generally thought that maybe 1,500 a pound, again, we're talking 5 years ago, might have been where we hit equilibrium. And the reality is a lot of these markets are hitting equilibrium at $800, and the more mature markets are obviously well below that.
Yeah, I've been reading a book lately, Jamie, called Win or Learn, which is by Conor McGregor's MMA coach. His name is John Kavanagh. And it's a little bit of a cheesy book and a little bit of a cheesy title. It sounds like something a dad like me would like in terms of giving lessons to his kids in this win or learn context. But basically the idea being that either you're going to win and things are going to go well, or if you take an L, which, we all take personally, and we've all taken plenty of them professionally as well, take the L, but learn from it. So let's dig a little bit further into Ayr, Jamie, and maybe just kind of talk from a big picture perspective. I know you're close there, and so you need to be a little bit careful in the things that you say. But when you look back at that experience, both just at Ayr yourself, but even more just kind of big picture, looking at it as a case study from the outside, what are a couple of the wins that you saw there? And then in a second, we'll dig into a couple of the L's or a couple of things we might be able to learn from that experience.
Sure. So look, I'll give the teams a lot of credit on integration and systems. I think our reporting, our tech stack, our data, we spent a lot of time cleansing the data, creating, I think, some of the best reporting in the whole market. A lot of M&A deals, even outside of cannabis, right, roll-ups that fail, a lot of it's issues on, accounting, integration, like all those things. I'll give collectively both our operational and our financial teams a lot of credit for having, relatively few footfalls in that piece of thing. I think we're pretty prepared, and we were on, that part of it. So I think, that part was good. Again, I think we had some good markets, so we weren't, wasting our time like some others in the industry with one dispensary in this state or a processing facility and something where you had no ability to get scale. So we kind of had a clear lens of, we really wanted to see revenue potential per state of at least 50 million. And obviously would love to push up closer to 100, because if you're smaller scale than that with infrastructure, compliance, everything else that goes into it, I think it's very difficult, to make money as a public company with reasonable overhead and whatnot. If you're a smaller scale, if you're a private operator, you can run 3 dispensaries with, a lean management team, you might be okay. But that was sort of the guidepost that we set. I think we had a lot of work to do on the branding side of things, because each of these businesses had their own products and brands. And I think, one guy in particular that, led that rebranding exercise, I think did a great job of bringing brand cohesion and bringing the brands across the portfolio. So I think those are some of the things that we did, relatively well. In terms of some of the things that I think we all could learn from as a, case study, and the big one, no one will be, surprised, but I think this industry is a little short on talent, particularly on like operational talent. And particularly as you grow that quickly, it puts strain on the organization. It exposes, flaws. You got to figure out whether you can scale, the processes and systems and talent. And I think, we obviously, if you look, there was a fair amount of turnover, on the, operations, side of the business, in particular. I think over time, there were probably a few too many people from outside the industry that didn't have enough industry experience as well. And maybe just a little bit slower than we should have been to bring in, core operational talent to move from almost a private equity style holding company to a pure integrated operational team. And all those things just lost a little bit of time. And, some of the CapEx decisions, I think we'd, take back. But I think those are probably, 2 of the biggest, things outside of, that those correspond with the debt levels and or the lack of EBITDA growth to support the debt levels. that obviously got us in a bit of a twisted position, particularly when the Florida vote didn't come, and some of the other state catalysts got a little delayed, and outside of recently, the federal progress has gotten nowhere. I guess it's still nowhere outside of rumors. And so things could have gone very differently and worked out, very much better in a Monte Carlo simulation of if things had happened quicker or a different order. And it's unfortunate because there's a lot of great, people there, and we're seeing what's happening with exiting some markets, and a lot of people's jobs and livelihoods are being impacted, and that's the nature of restructuring and getting lean. And I think there's some decent decisions that are being made, and I'm reasonably optimistic on what that Ayr portfolio will look like on the back end in a reorganized fashion with a much cleaner balance sheet. But there's been a lot of pain that's gone on, and a lot of humble pie that I think everyone involved has eaten. But I think you got to learn from these lessons, and pay attention to what's going on in the industry, and make better decisions and be able to add value to other companies operationally or investment wise going forward.
One thing we've talked about in the podcast a lot is this notion of reform dependence, Jamie. And I think when we say reform dependence, people often look at federal reform, especially with 280E and the tax implications there. For other businesses, a Glass House or Leaf could benefit from a descheduling or states 2.0. So that's another, I wouldn't call that dependence in a lot of cases, but that's another, reform catalyst. So there's a lot of them that are federal. And I think those are, two different degrees across the industry, but most of us are levered to federal reform in one way or the other. The second way I think about reform dependence is on the state level. And I think back, Jamie, to a conversation we had with David Goubert in 2024, and you can probably correct me on the exact percentages here. But one of the strengths of Ayr, which I think was, a double-edged sword, was this notion that something like 85%, 81%, 80-some% of your portfolio was in medical states yet to flip rec. Yeah. And so when they flip rec, typically you have, revenue expansion, but often there's improved margins. And, that's a lot of time, there are good medical only markets, but generally tying back to what you said 15 minutes or so ago, you're trying to put money to work at lower multiples of medical markets. So when they flip rec, that's when those investments largely pay off. So can you talk a little bit about the challenge from a capital allocating perspective? Because I think you have to make assumptions about what that market can be in terms of size, your penetration in that market. But also, Jamie, I think that the notion of when does that market flip and how long are we willing to sit through the medical market to harvest the adult use can come back to bite you as well.
Yeah, no, I think that's spot on. I mean, if you look at the large markets Ayr had, and quite frankly, some of the other MSOs have as well, right, that are still medical, it's generally going to be Florida, Pennsylvania, Ayr won the tentative license in Virginia, and then Ohio, just flipped. So those are the markets that had the biggest, torque. Obviously, Florida being the biggest one. Ayr having 60 something dispensaries. There. I think the thing that doesn't get enough attention is, given that there's been a bunch of other markets that have moved to adult use, as well as hemp, which has become a much bigger headwind in the last couple of years than it was even 5 years ago, where we're generally talking about the illicit black market, is medical markets tend to shrink even more as the markets around them move to adult use. Pennsylvania being a great example. Pennsylvania's always been a pretty good medical market, but as soon as New Jersey and Ohio and other markets start going adult use, and those patients have access, and they think that their own state is going to move to adult use, people stop getting cards. They start, traveling out of state for, better form factors, cheaper pricing, not having to be on the state database. Even in Florida, ahead of the election in the fall of 2024, where people expected the adult use ballot initiative to pass, patient registrations and patient cards dried up. That patient growth, which was, I think, trending in the mid to high single digits, went to like 0. And it's picking back up now. I think it's back into the 3 to 4% range. But what happens is capacity is still the same. Patient growth fell off. And what's going to happen to pricing when you have the same supply and demand goes down? Pricing is going to go down. And so you do see some pressure on revenue and profitability in these markets the longer that they go relative to expectations. And so while I think in many of these cases, you'll still see a lift, my personal expectation in Pennsylvania is it's going to be much more of a yawner than if they did this 2 years ago, because there are fewer people that are underserved. You will certainly see a lift. I don't know if that lift is 25% or 50%, but it's definitely not 2 to 3x. Florida, you could actually see a bigger lift when that happens because of all the tourism, the international, the snowbirds. They don't have medical, reciprocity. So I do think you will see a pretty chunky lift out of the Florida market when that happens. But again, you still have some of these other mature markets across a lot of the states that are seeing negative organic growth. And so I think we all thought, 3, 4 years ago, 5 years ago, you had mid to high single digit organic growth, and then these state level catalysts just stacked on top of each other. And what's happening now is you're getting, let's say in Ohio, that goes, rec, or, Rhode Island for some that have some exposure. They're nice little boosts, but if you have a large business shrinking 5%, the AU lift maybe just gets you back to flat, or you grow a little bit, or you only shrink a little bit. And it's basically shoring up the wounds as opposed to providing incremental growth. So, I think that's been the challenge, is there's a leaky sieve that's been going on under the water, and not all the operators obviously break out, the market specifics. But I think that's been the challenge of growth. And in the last bit of time where you haven't had a lot of state level catalysts, that's manifested in terms of the top line numbers of the industry, which have been pretty uninspiring, unfortunately.
Yeah. Another name we've been talking a lot about, in addition to Ayr, Jamie, is Glass House. And I think last time you and I saw each other was at a Glass House investor sesh. And I think we're sharing a joint after the investor day, maybe
right.
in 2023 or 4. I forget. Everything tends to kind of blend together there. But maybe you could just give us some context into your relation with Glass House, how you got involved, how you were on the board there, and how that ultimately came to an end.
Sure. So before I jumped, into the operation side at Ayr, we had set up a second SPAC vehicle, primarily focused on California and brands. So sort of a different business model than the traditional MSO business model. And I had known Graham for several years through the industry, and I met Kyle Kazan along the way. And so we had a shared, vision. There was a unique opportunity. They had obviously a good operation in California on the cultivation side down in Santa Barbara, as well as a nice retail and brand footprint. But what really made the opportunity unique was there was a unicorn of a greenhouse facility, which you and I have seen many times, down in Ventura, California. That was a 5 million square foot state-of-the-art high-tech greenhouse. And we've all seen a lot of failures of greenhouse conversions in Canada. You had Flower One, you've had plenty of others, but people tend to either take, janky facilities and try to retrofit them into cannabis, or they're simply in the wrong growing environments. What I appreciated about this facility was this is where produce is grown. It was a very high-tech, automated facility that produced cucumbers and tomatoes that were being sold at Trader Joe's and Whole Foods and Costco. So it was built for, institutional grade, supply. They had on-site, solar, cogen, power facilities, distribution warehouse, areas for, trucks to pull in. And basically what happened was you had an entrepreneur who had had that asset in his family for, I think, a generation or two. Mm-hmm. The economics of the tomato and cucumber business declined because of some of the imports coming out of Mexico. He was forced to sell the real estate to a real estate private equity fund that had an indoor farming thesis, but he kept an option to buy it back. And so what that gentleman did was he went to Ventura County, lobbied for commercial, cannabis legalization, got that done, but then basically didn't have the $80 or $90 million to exercise the option. So we basically teamed up where the SPAC transaction included the greenhouse, the Glass House assets, and some smaller, retail operations where we could combine the capital, the growing and genetics talent that Glass House had, where we thought we could create the largest scale operator in California. And as much as California is a ridiculously hard market, and we've all heard about the challenges on taxation, growth, black market, and everything else, I think this is a one-of-one facility that is, call it the Saudi Arabia, a moat of being the low-cost operator is a real moat. And I know they've been in the headlines for some ICE raids and other things, which is a bit unfortunate. But if you look at that last quarter, I think their grow costs were $91 or $95 a pound, right? Now that's on biomass, not flower. There's been some discussion on that. Maybe it means it's $200 a pound on flower or something like that. But MSOs across the board in general, I believe at a high level are probably growing at $700-800 a pound, right? So this is a massive, and by the way, that's probably a biomass. I'm not even sure, people report things differently, whether that's biomass or flower, but they're growing at 10 to 20% of the cost of most of the MSOs. Why is that? They don't have much in the way of energy, right? They have great sunshine, low humidity. This is where produce is grown. They have that on-site, solar and cogen. They have massive automation. Graham, for those who don't know, he's a wonderful guy, one of the best operators in the space. He was previously one of the co-founders at Sonos, the music company. He's a tech guy that loves weed more than just about anyone I know in this industry. And he is constantly tinkering with, automation, ways to, limit, touch points. And what they've done in that facility is so different than any of the other 100+ facilities that I've been in across this whole industry. It's hard to comprehend unless you go there and take a tour. So I think they have something incredibly unique. They make massive margins below the marginal cost of almost all of the operators. And what I like about their business model is they've now gotten to the point where they're generating enough revenue and cash flow. They've refinanced, a lot of the debt. They truly have a lot of one-sided optionality, right? We don't know exactly how big the hemp opportunity might be for them, or when interstate or international commerce opens up. It will happen at some point, but they don't have a gun to their head anymore because they've gotten past those initial stages where the business is sustainable, and now it's just a matter of timing, right? And that's the hardest thing to predict. But going back to, you don't have a need to be so right on timing, whereas I think some of those MSOs, Ayr included, it was the point where if those things aligned, we would have had a great run. But unfortunately, they didn't come together at the time that we needed relative to the capital structure constraints, and that option got short-circuited, right? And so I think Glass House has a business model that will win far into the future. And as much as there's some great MSO operators, and I think many of them are undervalued, there's a lot of question marks on the MSO business model. And there's definitely scenarios where they're big winners. But I am concerned about, if cultivation, if product is flowing across the country, there's going to be a lot of mothballed cultivation and production assets that are high cost and won't be economically feasible. I think some of the brands, as much as people have put a lot of effort and are trying their best, generally speaking, MSO brands don't have as much authenticity and credibility as a lot of the brands that have that legacy out of California or Colorado or Washington or Oregon. There's obviously exceptions. Some groups have done better than others, but you're seeing now the Stizzy and Wild and Kiva and Jetty and Timeless is, move surgically, to the East Coast. And more often than not, they move up the BDS and headset rankings pretty quickly. And so that, makes you question, do MSOs have brands, or do they have products that were the only game in town for a long period of time? And I'd be more confident if they were able to win in an open architecture market like Michigan or Colorado or California, but we haven't seen enough of those studies yet. And obviously, there's definitely some respect I have for what some of the MSOs have done on their brands. I think others are private label products at best. And I'm concerned about the capacity utilization and the economics of that part of the business if things open up. But you could see retail margins expand if you can source product, much cheaper than they are today. I'm sure retail pricing will come down a bit, which might open up the addressable market relative to the illicit market. So they could skate through. But like I said, I think Glass House has something that's going to win over the next decade. And I think the MSOs might win, might lose, or might be somewhere in between. And it's really hard, to figure out exactly how those business models will sit over the long term.
Yeah, to give people a bit of perspective just on footprints. So Glass House is 5.5 million at full capacity. I can't remember. I don't know if you know offhand, Jamie, how much of that they have turned on today.
I think it's about 2.5 million or 2 million, something like that.
Okay.
So they're running about 40 or 50% of their ultimate total capacity.
Okay, so Glass House can be 5.5. They're at about let's call it 2.5 million square feet right now. At Leaf, Jamie, we have a 187 acre permit, which is one of the largest in the state and the largest in Santa Barbara County. Right now, we're cultivating 65 acres of that. So that's about 2.4 million square feet. At full capacity, we'll be over 8 million square feet. So again, today, the footprint with us and Glass House is similar. They get a couple extra turns because of the greenhouse. We get 2 turns out of our sun-grown field. Again, at full capacity, we can be over 8 million. They'll be at about 5.5 million. And compare that, our footprints at Glass House and at Leaf today are bigger than the entire footprint of businesses like, Cure Leaf and True Leaf.
Yeah.
And you mentioned Glass House cultivating at about $100 a pound. We're doing something different. We're going for extracts, but we're closer to $10 a pound. Yeah. And so, yeah, I think it's an important thing for investors. And I know the MSOs are aware of this, but if we get to descheduling or something like States 2.0, there's a potential pretty big disruption on the horizon there.
Yeah.
Do you think the MSOs will be lobbying to slow that ability for product? Because, to your point, there's billions and billions of dollars of fallowed assets and jobs and tax revenue, right? So, it's kind of like how alcohol prohibition. I'm just kind of curious how you think that transition.
Yeah, look, I think it's not just going to be MSOs, right? You have a lot of capital that's been deployed in this market. So you have a lot of jobs, you have a lot of tax revenues, from the state. So if you're sitting there as the head of Illinois or the head of Massachusetts or what have you, you're not so excited that all these jobs and capital and business is going away in your state and all this cheap California weeds, coming in. So there are things they can do to make things a little more difficult or to, drive some tax revenue, right? You can set things up sort of like the wine, model, where there tends to be kind of a 3-step distribution and some taxes along the way. So even if the, flower and the extracts are cheaper coming out of California, by the time it gets to some of those states, it may not undercut, those markets as much as the, commodity price of those things. There's I've heard some angles around testing. Some of the states have even more stringent testing than California. So you could have, testing that would make it difficult for at least some of the California operators to move their biomass across, state lines. And, look, this is not going to be frictionless. This is not going to be easy. I'd expect there probably at some point to be litigation and other things. But quite frankly, it's also one of the reasons why it's been difficult to get cohesion in the industry of getting everyone on the same page from a lobbying or national trade group perspective, because there is divergence of interests. What is best for X MSO may or may not be best for X California operator. And while we all want to see this be descheduled or rescheduled, I think there's relative, winners or losers. I think the MSOs definitely want a states' rights, type of model. And I'm sure the California, operators want a free-flowing, federal legalization model, similar to Canada, or similar to Canada without the government-run, distributors and retailers. So I think we are going to see some, progress. Fingers crossed. It feels like the tea leaves. It feels like this time is different. Obviously, I said I wasn't going to talk too much about this because as much as anyone digs in or talks to everyone they know in DC or whatnot, I think the reality is if you've done this for a long time or done merger arbitrage, you realize you don't know what you don't know, and having too much confidence in this is a fallacy. So I think the only way to operate is to assume it's not going to happen until it does, and it's not even worth wasting that much mental energy, on what you can do, because as a single operator, you probably can't shape the outcome all that much unless you're one of the super big guys. And so day to day, assume nothing's going to change, and then when it does, be prepared of what you're going to do, differently, if anything.
Yeah.
Well, Morgan, we've got about 10 minutes here. You want to talk maybe a little bit about challenges in 5 or 6 minutes? We'll wrap this guy up.
Sure. So Jamie, you were talking about, how debt was a tool to fund growth. And I'm just curious, when you think back on it, was it really because that was the available capital relative to equity? Like if you think about it today, some of the challenges we talk about here quite a bit is, the balance sheet. The quality of the balance sheets has been under stress for quite a while for everything you also has, mentioned so far today. But, and they're trying to get operational improvement, but it's really hard without growth to get out from underneath that balance sheet. So, where do you see, maybe less so about what has happened and what's currently happening, what do you still see operators getting wrong, or what could they be doing better now that we're here?
Yeah, look, I think across the industry, there are various times where debt was the only capital that was available. I don't think we've seen much in the way of like public market equity raises for quite some time. I can't even remember when the last one, was.
Yeah, Jesse.
Yeah, we just did a raise, Jamie. That was
Okay.
that was oversubscribed, but it was on the smaller side. It was a couple million bucks.
Right.
But yeah.
Actually, I'll take it back. Vireo, right, did an actually incredible raise with the Chicago Atlantic Group for that roll-up that they're doing. But I'm saying the regular way secondaries that we saw, I think back in 2020 or 21, right? Those have been long gone for quite some time. But I do think in hindsight, some of the operators and board members and others probably were too cute about dilution relative to thinking my equity is too cheap, I can't sell equity, right? Because if you look out 2 years, I'm going to be trading at 3 times EBITDA, so why would I sell equity now? I can do it later, and I don't want to incur that dilution. And then unfortunately what happened is you didn't see the EBITDA growth or what have you, and that never manifested itself, and then you ended up more over levered than expectations relative to the cash flow of the business. So look, having X% of something is much better than losing the equity for sure. And so I think for those that have the opportunity to bring in equity or to delever balance sheets, I would encourage people to get in front of it as opposed to waiting and hoping that a state goes AU or the capital markets thaw. And that's one of the biggest things I would do. The second thing is maybe staging, growth and investment a little bit more lockstep with the growth in natural cash flow of the business. I think there was this pressure that if you didn't build it quickly, you were going to lose the race, right? And now I think that whole mantra, has changed, and you're seeing quite a number of smaller operators, I hadn't even heard of Leaf 4 years ago. I don't even know if they existed, right? Or Grown Rogue, or you've seen some really good private operators. C3 does a good job. Good Day Farms, right? You're seeing a bunch of other second or third movers that have been a little bit more patient, that are buying assets that are either distressed or they're picking out at very attractive valuations. Like now is almost the time that if you had a pool of capital would be very interesting, right? You want to be Oaktree in 2009. Not the group that just ran a credit portfolio into the ground and is sitting there licking your wounds with no fresh capital. So I think part of it is timing. A little bit of that sometimes is always luck and serendipitous timing. If you happen to start a fund, are you smarter in terms of putting up the returns over the next 3 years, or was it just that if you had been there for the last 3 years, you'd be licking your wounds like everyone else? But I think just building that capital structure for permanence and for the next, 5 years in a more bulletproof way, I think everyone would have made more conservative decisions, tampered down, that urge for growth, and been a little bit more patient. And I think, with the exception of maybe a couple people, I think everyone in this industry, probably could have done that better, myself included.
Yeah. So, one thing that we get pitched quite a bit, let's say you had a pool of capital right now, because I do think this is actually probably one of the most interesting times. If you had a fresh pool of capital, you could do so much. But one of the things we get pitched are distressed funds. We're going to go buy these distressed assets. We're going to clean them all up. Or if you had a pool of capital, would you choose go after distress where you could buy them extremely cheap, but you have a really strong operating understanding of what that really means, versus if you had a pool of capital and you could pay a bit more and go after more of like a quality at a reasonable price? How would you think about it with everything you've been talking about?
Look, that's a difficult question to answer at a high level, right? And the benchmark for all these things has to be some of these good operators, that we talk about. I mean, you look at, GTI with a clean balance sheet, good management team, good operations, trading at 6 times EBITDA. I think Trulieve and Verano are 4 or 4.5 or something like that, right? So can you really buy distressed assets at substantially lower multiples that don't need, capital or something, or you're inheriting balance sheet or tax liabilities or other things that create such a better value entry point, especially relative to the talent and systems and whatnot that you need to execute? Is that actually lower risk or not? And I'm not 100% convinced right now. There may be, one-off, opportunities that are easier to digest if you saw a small handful of dispensaries in one state that you could, buy pretty cheap and where what the playbook is to extract value. And I think that's where we're going to move to. It's going to be a little more like private equity, where you had, the years where you could just buy stuff. Now I think you have to have the playbook of what you're going to do with it when you own it. I think the operational alpha may actually be more important than the valuation entry point, because everyone's going to see those. There's lots of opportunities out there. There's going to be more. There's going to be plenty of stuff to buy. The question is whether you have the team that can actually turn them and make them substantially better. Now, the good thing is there's a lot of mismanaged assets and there's a lot of low-hanging fruit. And if you have the team and the expertise to go do that, I think there will be opportunities. But if you're just buying broken assets with maybe not super sophisticated management teams that aren't like amazing, I'm not so sure that that's the secret to success over the next couple of years.
Yeah, I think that's good advice, Jamie. And I think you also have to approach it with a perspective of humility, which I think all of us have been, become, more humble. Man, I've been just becoming more humble every single year I'm in the cannabis industry, and, be humble when evaluating deals too. I think sometimes people look at stuff and they say, I'm going to buy this thing that's, losing money now. And when I come in, it's going to be different. I'm not sure it always works out that way. And so I think that, in the win or learn type mindset, I think that from the L's we've taken, hopefully we've all become more humble, both in terms of how we carry ourselves, but also in the way we approach deals, and not assuming everybody else is a moron and I can fix broken things.
Yep, things are always harder and take longer to fix than you expect. And oftentimes there's a reason that's a little bit more structural of why things are harder, to turn around. Because let's be honest, not all the businesses are run amazingly well. And so if there's something that's substantially worse than other things, it's not all because they're substantially operated worse, right? If you have a low volume dispensary, what are you going to do, right? Like $2 million dispensaries lose money and they're not worth anything, right? And you need to get them up to, 4 million, 5 million in most markets for that to make sense. That's hard, really hard. And so a lot of times I think people are buying liabilities when they think they're buying cheap, right? And so you have to have a very clear playbook. I think you have to be humble, you have to be conservative. And the things that are the biggest turnarounds, you really have to pay as little as possible, understanding there might be additional capital that needs to go in. It's going to take longer. And maybe there's some way to share incentives through earnouts or other things that if things work, that the seller gets some increased value. But I think now is not the time to pay up, assuming you're going to have massive value creation. Quite frankly, I think that's going to accrete to the buyers in this current market environment.
Well, this has been great, Jamie. Unfortunately, we had 2 more sections that we didn't get a chance to dig into, so maybe we can have you back later this year and catch up some more and finish up those sections.
Absolutely, would love it.
Hey, Jamie, can you tell people what you can help them with in this world of cannabis and where they can find you if they're interested in having a chat?
Sure. So I started a firm called Pacific Grove Advisors, which primarily is providing interim management, turnaround, and consulting services to the cannabis space, as well as some family offices and investment funds. So it's been great to reconnect with many folks across the ecosystem in this community. I have a lot of great relationships, and I'm excited to see where my expertise and background can be most helpful to take a small handful of companies to the next level.
And do you have a website, or should people reach out via email? What's the best place to catch you?
I'd say LinkedIn is a great place to catch me. And it's Jamie, Jamie, at pacificgroveadvisors.com.
Awesome. Well, Jamie, appreciate you taking the time. Morgan, always good to chat with you. Thank you all for listening. Don't forget to watch on YouTube, and we'll talk to you again soon.
Thanks, guys.
The views expressed in this podcast are provided for informational purposes only. Nothing we said should be considered research nor a recommendation. All investing involves risk, including the loss of principal.